You know, it's been a pretty amazing thing seeing everybody from all the different angles of you know, digitized securities and how we all come together. But to give you a little bit of background of who I am, my name is Shannon Robnett. I'm a second-generation builder developer, fourth-generation realtor. I've been in the space of development and construction my whole life, and it's exciting to see how something as old as, what's that? Yeah. Something as old as construction being remodeled and remade with digitized securities. And the reality is that old dogs can learn new tricks. You know, Chris and I were just laughing because really our last PPM that we sent out 2 months ago was with DocuSign, right? And now here we are, we're doing our first digitized asset offering this next week on a platform that we had built with Vertalo, right? And so it's amazing how quickly that space changes. But the thing that we saw in that is I'm standing there having been in real estate, having been in investment properties my whole life, sitting here realizing that the lockup period can be eliminated, right? And that's where we really kind of focus on making illiquid assets liquid again. And how do you really do that? Because what you see in the marketplace is not that. But we started out here with a little thing called definition, right? And it's funny because when you look at the definition in Investopedia, it says not easily converted into cash. So I guess we got to kind of update Investopedia about what else you might want to convert it into besides cash, right? But the reality is that when we look at what syndicated funds are, and I'm going to assume most of you are familiar with syndications, but syndications are just a fancy word for partnership. And it's where a group of guys get together, guys and gals get together and create an LP-GP situation. One person is making the decisions and is moving forward in the space as far as the development of the asset. And the LPs are passive in that, so they're not doing much, but they're enjoying the benefit of being involved in whether that's a large-scale development, whether that's you know, multifamily or other forms of commercial real estate. We're even seeing that in the, we've got some friends that are doing syndications in carbon credits, syndications in you know, the field of Bitcoin mining, right? So we're seeing all kinds of applications of syndications, but there's basically just the director, the general partner, and the limited partners. But the reality is everybody else that got in on the LP side has to do everything that the GP says, and they have to go along for the ride. And if the GP wants it to last 5 years, it's going to last 5 years. If the GP wants it to last 2 years because he wants to exit early, then it's a 2-year deal. And nobody in the LP side really has much of a choice in that until you start with the tokenization process. And when you start with the tokenization process and you go through the lockup periods, depending on what exact format you use, whether you're doing something in a 506B or a C or a CF or Reg A+, you're dealing with different lockup periods. But the reality is at some point, much sooner than the exit of the GP of the initial investment, you're able to go to a secondary market for liquidity. See, to me, this is a side effect of what liquidity can be because of tokenization. So when you look at security tokens, they'll completely change the access to previously hard to create liquidity with high refi costs or need to sell assets because we're no longer bank controlled, right? If you go back to the real mission statement behind blockchain, it's about decentralizing it. And when you look at, you know, a typical deal that we do has 2%, 2.5% finance costs in there. By the time you go with your soft costs, your hard costs, your points, your loan origination, all of those kinds of things. With tokenization, you don't have that. And the person that gets to decide when and if they want to move the tokens is the one that issued them, or the one they issued them to, right? And so the reality is that in a very short period of time, you're able to exchange those tokens at your discretion. We know that a lot of times in our syndications, everybody sets a limit of 50,000, 100,000, that really kind of in a lot of ways limits who can be involved. The reason that we do that is because we just finished a raise for about 15 million on an apartment complex, and we had, Chris, what, 45 investors on that? But can you imagine if we did that in $100 increments, right? right? It would be mind-boggling what you would have to do if somebody wanted, if you had to go pay that out on a monthly basis. But with the blockchain technology, with this digitizing that security, you create a digital record that you don't have to manage. It's a distributed ledger by definition, right? So the reality is now it opens the doors to say, hey, we can lower that minimum investment amount. We can now make that liquid, right? So by combining digitized securities, tokenization, and real estate, you can get to higher cash flows. Well, how is that? Well, let's think about that. From a syndicator's point of view, we're going to go in and we're going to, the best example is using a value-add product. So we go in and we buy an apartment complex for $10 million. We put 20% down, 25% down, so we capitalize $2.5 million. We bring in another $1 million in CapEx. We repaint the building, put new deck chairs by the pool, raise the rents $100. We've now changed that from a $10 million asset to a $15 million asset. And then in about 2.5 years, we're going to refinance that. We're going to spend 2 points. And with that, we're going to return most of the LP capital, right? But what if after 366 days, the lockup period required for a 506B, you were able to decide that you wanted to liquefy that? And you were able to look at that and say, wow, I'm okay making 20% on my money instead of waiting for better than that when we get to a $15 million valuation. I want to liquefy now. It puts you in that driver's position to be able to do that through the tokenization process. So the liquidity inside of this is really amazing. The other thing that it's going to be able to do is in generation of wealth. One of the things that we're looking at in our platform is turning this, as soon as we've gotten our syndications up and running and got that platform where we're introducing syndicators and investors, because as syndicators you have too much deal and then you have too much money and on and on and on. But turning this toward the tenant, right? And if you think about what a tenant has learned to understand, they've learned to understand that if you ever want to get out of an apartment, you put your money in the bank. And the bank's going to pay you 0.001% on your savings until you've saved up enough money for a down payment on a home. But what if that liquidity was available to you to invest in the commercial scale asset that you lived in? Now you're getting an 8% return or a 9% return or a 22% IRR, as are available in a lot of these, by investing in the place you lived, right? So there again, it creates a liquefying event for investors to come on board, to get out when they want, for tenants to get in there, to begin to create wealth. But by digitizing and tokenizing real estate, you're really backing it with a hard asset. So it answers a lot of the questions behind, and I know you guys all know this, answers a lot of questions behind how are we really believing in this technology, right? What is really, it answers the question of what is behind Bitcoin, right? I'm tired of answering that question for my dad. I'm just done explaining it, right? But the reality is when you're backing it with hard assets, you're hedging against inflation, you've got something that produces cash flow, and you've also put it in a space that allows people to continue to have control of that, to continue to trade that, and to continue to be in control of that. It provides stability through transparency, right? When you think about a smart contract, currently right now, most syndicators use a paper contract, right? And that paper contract is sent out. We've got 45 of those floating around. They're all the same version. They all have a date on them. But what happens if the lead syndicator, the GP, gets hit by a bus, right? You combine that with the smart contract. Now that is functioning and executing per plan, per the smart contract, regardless of what I'm doing about it, which gives you guys the transparency and the ability to understand that this will happen exactly like we said in the PPM. And so at that point, you're able to understand that you have that stability, you have that ability to know that it's going to go on just like it was supposed to. Then you have the fact that it's a regulated security, right? It's a 506B, but it's also digitized. So now it's an immutable contract that the SEC is overlooking, right? So there's that additional benefit. And you combine that with the tax efficiencies that you get from real estate that you don't get from other digital securities, right? So you're not going to get any tax advantages from Bitcoin, right? But if you have the liquidity, let's say that you use a DeFi product and you stake your Bitcoin, you convert it, you bring it out of your wallet, you put it into a platform like ours, you purchase real estate with that. With real estate comes depreciation. With real estate comes tax advantages. And now you're also going to generate cash flow, something that your Bitcoin wasn't really going to do for you, in a situation that's now also tax advantaged. So the reality is, behind all of the creation is getting back to the true point of the liquidity that we're all really looking for in this. And like I said, you build that in with the smart contract so that it's now something that happens autonomously. I don't know if any of you guys have spent any time with the guys over at Invinium, but they're working on a smart contract that is able to work with if-then statements. So now you look at the liquidity events and you look at, in the syndicated product, we want to get an 8.5% cash-on-cash return. When we get to a 1.5x, we're going to do a refinance. When we get to a 2x, we're going to go to a sale. You know, all of those things are coming, and they're coming very, very quickly. We had the conversation about the bond, right? It was mentioned on the panel earlier, right? And we've already seen that start to work out, where there's a couple players out here that are looking to put together that bond. How would you compare a muni bond to something that was going to be a bond in real estate? What you would need is verifiable data. The blockchain technology creates that verifiable data so that you're able to put that due diligence on chain. You're able to put all of the reporting on chain. You're able to pull all of that together, so you're able to create that level of security and that level of transparency that creates to a higher level of liquidity. As we all know, the riskier things are, usually the less liquid they are, right? And so as you see this transparency continue to work its way through our market, and the acceptance of tokenization as a digital asset transfer, you're going to see a continued level of liquidity come to assets just like this, and the DeFi rates are likely to continue to escalate, where you'll be able to get 60 and 75% loan to value on tokenized real estate, allowing you to free up the capital that was previously locked up in some of these deals. So,
what's the company you mentioned that's doing the if-then statement on blockchain?
they're working toward that, and that's Invinium. So, but I wanted to kind of run you through the MVE model of what we do when we bring on a syndicator, because as you guys have seen, there's a lot of capital floating around trying to find a spot in this digital space. And it's really about connecting the dots, right? I mean, you've got people are wanting to put money, they're wanting to place something, they're wanting to hedge against inflation, but where is the deal? Where are you finding the deal? And so I just thought we'd bring on the onboarding process of when we bring on a new syndicator, and we've gone through that vetting process and we've checked their track record, we've seen what their other projects are, we've spent the time and the effort to make sure that they are the right kind of people, because good real estate happens to bad people and bad real estate happens to good people. It's just a matter of how the operator handles it. So once they've brought that on, we pass them through there, we bring that onto the syndicator onboarding process. We go through all the documentation, the PPM, we get that through legal counsel. We believe in making a customized PPM for every single event, going through the waterfall the way you want it, setting all of that up, and then bringing that out through a packaging and an offering on our platform where you're able to then put that out to the masses. One of the things that's very, very important is that people understand that when you're putting that on an offer wall, you're in a space that you have already completed all the KYC into that space. So everybody that's in that space is qualified to see that offering, which is another part of the transparency that we bring. So after that, we brought the PPM, we've got the offer created, we put the offer wall out there, the offer gets funded. Once it's funded, it's tokenized. And depending on the lockout period, it's then set aside until that lockout period expires, and then it begins to trade on a secondary platform. And that's where the liquidity event happens. Really what that does is that allows for syndicators and it allows for investors to be involved in multiple investments on a more rapid deployment of capital, rather than having to wait through the 5 or 7 year process that the syndicator has indicated in their PPM. So it's really kind of a thing there that is just speeding up the mark to market and getting from the place where you started on the investment to the place where you can redeploy that capital. And a lot of that has to do with timing, but a lot of that is going to change, and timing as we go into the tokenized space, and really being able to put that digital asset in a place where it's now at the discretion of the token holder as to how long they're going to hold that asset. So that's really kind of what we do at My Vertical Equity, and our goal is to put syndicators, qualified syndicators, in a place where they can meet qualified investors. It's kind of like a dating site for your dollars, right? So yeah, well, and that's what the liquidity event is all about, right? So we're kind of like where CrowdStreet and Coinbase got together and made a baby, and hopefully it's not as ugly as some of the ones I saw. But that's really what our goal is. And I think that really what you're gonna see is, as this continues, the biggest questions that we're going to see need to be answered are not, is this a good idea? It's about educating the public about what it really does for them, right? Because at the end of the day, when people truly understand it, I mean, I can sit here and have a conversation with my dad about Bitcoin that goes nowhere. But the minute I start talking to him about digital title insurance, he completely gets it. But that's what chain can be, and that's what it should be, to allow that liquidity to happen inside a syndicated asset. So a complicated, $65 million deal or $165 million deal, having the liquidity to move around through there and not make it a complete pain for everybody involved is really the ideal situation that we're trying to create, the question we're trying to answer at My Vertical Equity. So with that, I won't bore you with anything else. I was told 20 minutes, and I think I got it. So with that, if you guys have got some questions or...